Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, as you probably know, I like to keep the content evergreen, meaning that I want to teach you something today and you could use it tomorrow and the next day. But right now, based on the state of the markets, I think it's important for me to cover where the markets are. However, with the keeping things evergreen in mind, what I'm going to show you, you could use from now on, just in case I get hit by a beer truck. You're like, oh, what was that sell signal Dave talked about? Yeah, I see that getting ready to happen in the market. So that'll make a lot more sense in just a few minutes. So I do want to talk about the state of the market, downtrend, and sell signals. I want to talk about what to do when the market gets iffy as it relates to the core methodology. We would try to get through these trading resolutions, but the market keeps getting in our way. So we'll try to get through the rest of those today. By the way, housekeeping, I do take requests. If it's something you want me to cover, send us to davelandry.com/contact. As I say each week, if I can't fit it into this venue, I can cover it in my weekend charts, which is most every Thursday at 7 o'clock Eastern. We'd love to have you there. As you know, these shows haven't been live in a while thanks to the virus, but my weekly weekend charts are live, so you can come live and participate if you don't have anything better to do. If you want follow-up information, the slides from this presentation, all the other presentations combined, and enough stuff to keep you busy for a long time, including limited access to the members area, go to davelandry.com/StockCharts. And again, to register for the weekend charts, davelandry.com/webinar. We'll register even if the link or the date is old. I probably won't be doing a show next week due to the market holiday, but after that, I'll be back to my regular schedules. All right, let's talk about the methodology in action. And I want to follow up on a mystery chart as part of that. Now, the question often is, okay, Dave, the market's getting a little iffy. Why not bail on everything? So I just took this snapshot of portfolio from a little while ago. This doesn't have today's prices in it. But the reason we don't bail is through the money management, the position in money management, we're getting in a swing trade, and we're hoping, I know you should never use the word hope, but hopefully it hits the initial profit target, and you can see the white in here. This was the initial profit target on these, and then keeps on going, and we're with that position for a long, long time. Now, what I'm saying is we don't exit existing positions, but what we do, obviously, is we look to get short if the market is rolling over. You can see we've got a couple of shorts working it here. And on the long side, the only thing we change is we just get a little bit more selective. And usually the market takes care of that for us. It's very hard to find any decent look at longs right now, given the state of the market. But I was able to find this KLXE, and this is an energy stock and also a form of mystery chart. We'll take a look at that in just 1 second. So I thought it'd be kind of cool, I know you want to party with me, to put the stocks below the S&P 500, the ones that we've been holding for a long time. And here's ARLP. Notice that the market made all-time highs right here, and then obviously began to implode. And what did our stock do? Well, our stock went up and made brand new highs, and it since pulled back a little bit. But for the most part, especially when you compare it to the overall market, it's really hanging in there. Now, this is not to say that it always works. I want to make sure I show you one that didn't work. And this is the APG, which we've been in forever. Notice that it made highs with the overall market and sold off. It happens, spelled with a silent SH. Now, we haven't thrown caution to the wind on this one. We do have a stop in place. And remember, we've been in this thing forever. This is a weekly chart, okay? We've been in about a year and a half, and we've been trailing that stop longer term. Remember, again, we take the swing trade profit, if offered, which is 1% of the entire portfolio. And so that would be $1,000 on a 100K account. And then we trail the stop higher. We move the stop to break even, and we trail it higher, and hopefully stick with the position for a long, long time. So here's the one lonely new long, which is a former mystery chart. If you go back and look at the presentation back in middle of January, you'll see we had this one in there as a mystery chart. It made a bow tie, and that just means that the moving averages, the 10 simple, the 20 exponential, and 30 exponential have come together and have begun to spread out. They're changing from downtrend proper order to uptrend proper order. The entry was here, the stop was here, initial profit target was here, and it's obviously since moved in our favor. In fact, a little bit more since the snapshot. Thank goodness. So we have begun to bump that stop higher. Once it gets, or I guess I should say if it gets, maybe wishful thinking there, but if it gets to the initial profit target around 650 or so, we'll bump the stop on the remainder up to break even. And again, I hate to use the word hope, but hopefully be in it a long, long time. And hopefully a year from now, if the market gets iffy again, I'll say, well, we're still with this one because we haven't gotten stopped out. Now, as I've been saying ad nauseum lately, about, when was it? Right around somewhere in August of last year, I did a presentation called Before the Bomb Blows Up. And I wanted to do a market timing show as the market was making all-time highs. And the reason is, with market timing, you have to get ahead of it. As I've said ad nauseum, my phone doesn't ring when the market's doing great, but after the market drops about 30 or 40%, long lost friends and relatives begin calling me up in a bit of a panic. Well, at that point, the bomb's already blown up. So what I've been telling them lately is pay attention to these signals, and when we get some sell signals in here, you might want to take some evasive action. Now, one thing that I haven't talked about a lot lately, and it's probably the most important thing you can do, whether you're just getting started in trading or you've been trading for a long, long time, is to take a look at the net price movement. I get asked about stocks all the time. I'm a trend guy, right? I want to see a strong trend. And people say, hey, Dave, I like this stock. And it's like, okay, let's take a look at it. It's like, well, it hasn't done anything in a month, actually 2 or 3 months. Where are you seeing a trend? And all you need to do is look at where the price is today and draw a horizontal line going back in time and see where the price was. So obviously stocks haven't made any forward progress since way back last fall. And then obviously for most of this year, we've had a pretty serious slide to where we are now. So just by that simple little metric, where are we now, where were we, you can see that the market at best is going sideways, and at worst, much worse than that, obviously. Now, I've been talking about the TFM 10% system quite a bit, and all we're doing with this system is looking to sell when the market is 10% or more below its 50-week closing high, and also closing below its 50-week moving average. That's it. That's the entire sell side of this system in and of itself. Upside, a little bit more stringent. The thinking is, hey, I want to sell first and ask questions later. For the upside, we don't want to get whipsawed back in. So here's the percent from closing high. And this is all in the ACP plugin. If you have ACP, then like this video and you get the plugin for free, absolutely free. You're welcome. My point is, if a market is at or near new highs, not too far away from new highs, then give it the benefit of the doubt, at least longer term. So as long as we're within 10% of all-time highs, the market is okay. I'm not going to say you should rush out and buy stocks today, but if you've been holding them for a long, long time, maybe keep holding them for now, at least. Now, when I say stocks, I mean stocks overall. Obviously, follow your trading plan, as I just showed, by honoring your protective stop. So you can't read this. This is 42.89. Any close below that, once again, will be a sell signal based on this system. And just to remind everybody, once again, we got a sell signal here right before the pandemic slide started in earnest. And we got a buyback signal right around here. Now, if you look at the buyback, that's slightly higher than the sell. And you'll think, well, you know what, Dave, that's a whipsaw. And it was, but that's okay. The idea with market timing, as I preach, is less about beating the market and more about not letting the market beat you. And as I've said ad nauseum, that market dropped another 30% from that signal, and that's what I call the diaper change. So better to be on the dock drinking beer than and wishing you were out to sea than being out to sea wishing you were on a dock drinking beer. And believe me, I've been both. We were at a race where we were almost sunk once, and I've had we got caught in a low pressure system once, and I've been in some really, really ugly stuff. The one where we were almost sunk, we were about 300 miles offshore, so that was not pretty. Anyway, getting back to the market, the bow tie order, proper order for uptrends and proper order for downtrends, meaning 10 greater than 20, greater than 30 respectively for the upside, and 10 less than 20, less than 30 for the downside, can help to keep you on the right side of the market, as I've said quite a bit. As long as you're mostly green with the moving averages on a daily basis, and on a weekly basis, it actually works pretty good, although it will have some lag. The last two major bear markets it caught the pandemic slide. It was a little late, so sometimes you have to be careful with these longer term signals. But we're looking at the daily here. The daily will give you an idea when the market might be turning. Last fall, we did get a little iffy, and that's a good time not to bail out on everything, like I just said, but maybe honor your stops and respect the market just in case the rollover continues. We went back to being green for quite a while, or mostly green. Yellow means the moving averages are intersecting with each other, but not in one proper order or the other. And here you can see we went from green to yellow to red. Bit of a kind of a red light, green light caution. And when that occurs, you have to be kind of careful and at least honor your stops and maybe get a little selective on longs and then possibly consider a short or two. You don't have to go crazy bearish, but do pay attention to the situation that could be developing as things weaken. Now, I'm not a huge fan of the 50 simple moving average and 200 simple moving average, but it is well watched, and I do dust them off whenever the market gets a little questionable like it is now. And if you look at the Landry light there, just meaning that the highs are less than the average for downtrends and greater than the average for uptrends, it can do a pretty good job of helping to keep you on the right side of the market. I actually prefer an exponential moving average for this, which I'll show you in 1 second. But a simple moving average does fairly well. So if you take a look at like the 50 down here, you can see that we've been red for a while. Remember, this just counts the number of bars. We are below the moving average. So 1, 2, 3, 4, 5. You can see 1, 2, 3, 4, 5. And it's not the magnitude, okay, or how far away we are, because notice we're really close here. It's just the number of days since it's intersected the moving average. And you can't really see it here. We had 1 or 2 days right here, and then another 1 day on the 200-day moving average. The 200 is going to be a little bit slower than the 50, obviously. And you can see right there, little Landry light to the downside, and then we had one just recently to the downside. And then with today's action, we've intersected back above. Now, as I've been saying, if you take a look at these longer term, you can see that they can, again, like pretty much anything, trend following, help to keep you on the right side of the market. And one thing that's kind of interesting is we did get downside Landry light in the 200 fairly quickly. Now, this could be a slow signal, but we did get that fairly quickly. Notice that the 50 changed pretty quickly to the downside, and then the 200 followed it fairly quickly. So if you'd have waited even for the 200, you would have been getting out right around the same time as the TFM 10% system. Now, you're going to have a lot of lag with a 200-day moving average, but again, it can help to keep you on the right side of the market. Notice that we did have a lot of kisses and a little red here and there in the 50-day moving average. So you can see back here, the 50 turned a little quicker, meaning that we turned green quicker, and then eventually the 200 caught up with the Landry light. And of course, obviously, we've got a little red over here like we just looked at with the 50. Not a whole lot with the 200 just yet. So we do need to pay attention to the developing situation. And that reflects the Landry light up above, as you can see. Highs are less. Now, the one moving average I like the best in general for pretty much all markets is a 30 exponential moving average. And I would recommend that you pay attention to the Landry light there, especially because it'll give you a heads up pretty quickly. Now, you can get some whipsaw with this, obviously, but as a general statement, it really can help to keep you on the right side of the market. So obviously, we turned red during the pandemic slide, and we've had a little red in between going all the way back to that slide, but for the most part, we've stayed fairly green. A couple little areas to be concerned about, obviously, during that uptrend, but not a whole lot to get excited about, as you can see. But now we're getting more and more red, or mostly red as opposed to mostly green. So we certainly need to pay attention to that situation. You can see quite a bit of red there. It goes back to zero when we intersect the moving average, and then back to red again lately. And we haven't had any upside Landry light with a 30 EMA in a while. So the longer we stay below it, the more concerned I would be about the market. And as I've been saying quite a bit with any type of market timing, 200-day moving average, 50-day moving average, 30, EMA, whatever you want to use, or the TFM 10% system, it's the magnitude of what happens below the signal is more important than the signal in and of itself. For instance, let's say we have a dead cross in the market and everybody gets all excited. That's the 50 crossing below 200 because it's this major sell signal. Well, buying and selling when that happens does not really test out very much. I think Rob Hanna told me once, he does a lot of system testing, that he's got about a 4% edge in doing that. Really not enough to make it worthwhile. The thing is, though, occasionally after that signal or any other signal, the market has a really big implosion. As I've been calling and borrowing a line from Ian McActivey, has a pretty big diaper change moment. So here we have the Landry light zoomed in, and you can see it's red down below. This is a 30 EMA once again. We did have a couple of kisses of moving average, which resets the Landry light back to 0. But do pay attention to these pivot points in here. As I often preach, a lot of technicals come together at the same point. So 4,600 on the upside. We get past that. I wouldn't say it's the all clear, but I would say that things are certainly improving. And again, we're getting a little red to the downside once again on that. So a couple of random thoughts on market timing. You want to keep it super simple. Start with the net, and then begin to learn some of these other little systems in here. The TFM 10% system is a really simple system. I would pay attention to that. Landry light, proper order of the moving averages, or good things to keep an eye on. And as I've been preaching, and as I preach, market timing is less about beating the market and more about not letting the market beat you. If you're looking to retire and you're down 20, 30, 40, 50% or more, then your retirement's going to look a lot differently than if you'd have gotten out of the market and be willing to take that whipsaw, meaning have to get back in a little higher. At least you'll be able to sleep at night. Now, I really think a little market timing is better than none. Now, I'm not saying exit all your positions. If you're a trader, honor your stops, maybe consider a short or two, and then get selective like I just preached. But do get a little concerned when the market begins to get a little questionable and begin to rethink your longer-term market positions once you start getting some sell signals. So don't sell a farm when you start seeing the market get iffy, but do let positions play out, honor your stops, and only consider new ones if you think they could trade contrary to the market or if you have the mother of all setups, and, of course, consider a few shorts. Now, don't worry about looking smart. As I've said before, I'm kind of a man on the street kind of guy. I bumped into a man on the street, and he's like, oh, man, I'm so glad I held through that slide. And I've had several people tell me that over the years. And it's a little frustrating because as more of a trader type, I likely have gotten shaken out. Now, sometimes I make some, put some shorts on, and that kind of helps a little bit. But shorts can be tough. But it can be a little frustrating when the market comes right back. But as Greg Morris said, whipsaws are frustrating, bear markets are devastating. You can survive frustration. And again, better to be on the dock drinking beer, wishing me out to sea, than out to sea, wishing that you were on the dock drinking beer. So don't worry about looking smart. And people call me a trend-following moron because I don't worry about looking smart. I just follow along. All right, let's bang out these trading resolutions. That should read part 5. Now, when we left off, I was talking about reading my 3x5 card and talked a little bit about neurology. Now, the reason I talk about reading the card before every trade, something I probably should have done this morning, is that it helps you to kind of think about things with a bit more of a whole brain approach. You're not using that older primitive part of your brain. You're using the rest of what's sloshing around on top of it. And, you know, that goes to for life too. And I a couple of days ago, I made a little snapback at my wife. And I said to myself, you know, if you'd have just waited 2 or 3 seconds, you would realize that snapback was not worth it. And sometimes that's all it takes is a few seconds to go from your primitive brain to, again, the rest of what's sloshing around up there. Now, the point I wanted to make with the small change of looking at this 3x5 card, reading this card before every trade, is that if you want to make a big change in your life, All you have to do is make a small change. In fact, you're better off if you don't make a big change. And I use this example every year. And once again, I think they're on diets again. We have some friends that's like many of us, middle-aged, getting a little middle-aged spread, and they go on these crazy diets 2 or 3 times a year, and they always end up bigger than they did before. Well, the reason is your body is going to fight that change. So take more of a Kaizen approach, and I would recommend you read The Kaizen Way. It's a good book. Robert Maurer, I think, wrote it. I did see him speak a few years back. He was phenomenal. He was speaking at a conference that I was also speaking at, and I really enjoyed his presentation. Immediately got his books. And I recommend you read those books. But the bottom line is make small changes. And I'll give you, for instance, one of the stories that he talks about is a woman that could never lose weight, and doctors tried all these different approaches. And he told her, look, I'll tell you what, just stand for one commercial tonight when you watch TV. And then a few nights later, he said, stand for 2 commercials. And then it was stand for all commercials. And then it was, why don't you just march a little bit through one commercial? Before you knew it, she was running marathons. Now, I guarantee you, if she tried to run a marathon from the couch to from the couch to the race, her body would have obviously given out on her or resisted it. But if you make these small little changes, and I'm working on parsing some videos out, so keep an eye out on trading quick clips, and those are little smaller, easier to digest portions of video. And what I'm going to talk about, trading your brain, getting around the neurology that can hinder us as traders. In addition to document, something that I preach, your trader's journal, your emotional journal, which could be one and the same, you need to review those notes with the intent on deliberate practice. Deliberate practice, I would also recommend you learn more about. Malcolm Gladwell's talked a lot about that. I've written a few articles on that. I do have quite a few videos on my website and on YouTube on that. So study deliberate practice. In a nutshell, deliberate practice is not only practicing, but working harder to get better. It's deliberate practice. You're deliberately trying to improve what you're doing. So by all means, make sure you document everything, but then go in and look at those notes and learn from those notes and realize sometimes, again, it happens, spelled with a silent SH. Bad things will happen. Sometimes good trades will end badly, but as long as you're documenting that and realizing that, hey, you know what, this looked like a good trade going in, it still looked like a good trade even after I know it didn't work. If I saw this trade again tomorrow, I would take it again. And then the flip side of that, on a lot of your trades, you're going to think, what the hell was I thinking? So this kind of goes back to the post-mortem, but make sure you're really looking at your feelings. And the bottom line is, think about what you are doing that has nothing whatsoever to do with trading. And it's going to take a lot of introspection on your part. And you need to ask yourself, and I thought I could do a presentation without saying it, but maybe not today. What was it, intuition or intuition? We're trying to make something happen. Were you operating at your highest level? Did you get some sleep? Did you drink last night? Or did you stay up too late or whatever else? Make sure you document all those things. Again, as I preach, do your morning pages every day, 3 handwritten pages when you first wake up before you do anything else. Be really careful about perceptual distortion or selective perception. And was there any of that in your trade? Did you get shaken out of the trade because you were nervous? Or did you stay a little longer in the trade thinking it would turn around and go back in your favor long after your stop was hit? I did a presentation not too long ago on that. And if you check those quick clips, you should be able to find it on introspection. Dalio wrote an excellent book called Principles, and in it he talks a lot about another one of those. And trading is can be the definition of insanity, doing the same thing over and over and expecting a different outcome. When you have a viable methodology, you have to be willing to take several losses in a row. On the flip side, if you're taking bad trades that should not have been taken, you need to document those and make sure you take some actions not to take those trades again. And as I alluded to a minute ago, is there anything that has nothing to do with trading that caused you to get into or out of the trade? As I've said before, quoting Tom McClellan's late mother, Marion McClellan, Some traders trade when they have money, some traders trade when they need money, and others use more sophisticated methods. Sometimes if I'm super flush, doing really, really well, I'll take what I call an S&G trade just because I have money. Probably shouldn't be doing that, okay? So document that and make sure you're not doing anything that has nothing to do with your methodology. Number 22, I will go to davelandry.com/trading resolutions, print off the article, and refer to it often in 2022. And believe me, when I reread these trading resolutions and go look at my trading journal, I often find that I have made a lot of mistakes, and I imagine that you will too. And also, as a bonus, I will believe in what I see and not in what I believe. The market might not be doing what you want it to do, but what is. Well, that's all my time. I want to thank you guys for watching. If you need any follow-up information, davelandry.com/StockCharts. I'll give you enough to keep you busy for a long time. If you need to reach me, davelandry.com/contact. Thanks again for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.